Have you ever just wished you had a mental toolkit that could help you slice through any complicated problem? Well, today, that's exactly what we're going to build. And we're going to get our blueprint from a place you might not expect, the world of tax. Now, as a tax professor, I can tell you that the single most valuable skill we teach has almost nothing to do with numbers. It's really a powerful, structured way of thinking that you can use to analyze pretty much any complex, rules-based problem you'll ever face.
You know that feeling, right? You're staring at some dense legal contract, or a new company policy, or a financial report, and your eyes just glaze over. It feels like this impossible mountain of information, almost like it was designed to be confusing. That feeling of being totally overwhelmed, it's completely normal. But here's the good news. There is a clear, learnable method to cut right through all that noise.
You see, the secret is that professionals, we're talking accountants, lawyers, engineers, it's not that they're just magically smarter. They're equipped with a better toolkit. They have a system, a step-by-step approach to take a big, messy problem and break it down piece by piece, turning all that chaos into clarity. And today, I'm going to put that exact tool right into your hands.
Okay, so here's our game plan for today. First, we'll talk about why we're using a tax problem as our training ground. Then, I'll introduce you to the powerful 4-step ITAR framework. We'll immediately put it to the test with a real-world case study, breaking it down step by step. From there, we'll craft a final recommendation, and by the end of this, you are going to have a brand new tool for your own problem-solving arsenal. So why on earth are we starting with tax? Well, it's because tax is the perfect training ground for this kind of critical thinking. Think about it. It's a huge, complicated system of rules. In this case, the Income Tax Act is our official rulebook. The financial stakes can be really high, and the facts are unique to every single person. Plus, everybody has to deal with it. So if we can tame a tax problem, we can pretty much handle anything.
All right, let's get to the main event. This is the tool I've been talking about. In the world of professional analysis, we use a simple, memorable acronym to guide us, ITAR. That's it. Issue Tax Analysis Recommendation. It's simple, it's elegant, and it is incredibly effective at bringing structure to just about any chaotic situation you can think of.
So let's quickly break down what ITAR actually stands for. First, you identify the core issue. Then, you find the governing tax rule. But as you'll see, this T can stand for any rule that applies to your problem. Next, and this is the most critical part, you analyze how the specific facts of your situation match up against that rule. And finally, you wrap it all up with a clear recommendation. Issue, tax, analysis, recommendation. It's a roadmap.
Now, this first step, identifying the issue, it sounds almost too obvious, right? But believe me, this is the one step most people just rush right past. Before you can solve anything, you have to know exactly what problem you're trying to solve. What is the real question here? And why does it even matter? Defining the issue clearly is the foundation for everything else that follows. Without it, you're just lost. The second step is all about finding your source of truth. For our case study today, yeah, it's going to be a specific section of the Income Tax Act, but for you, it could be a specific clause in a lease agreement, or a company's HR policy on vacation days, or heck, even the assembly instructions for a new desk. You have to find the specific guideline that governs your problem. This is what keeps you from just guessing.
Okay, now this is where the magic happens. The analysis step is where the abstract rule meets the concrete, messy reality of your problem. You take the criteria you found in that rule from step 2 and you compare them, one by one, against the specific facts of your situation. It's a systematic process, like a checklist. It's not about a gut feeling. It's about methodical application.
And finally, we land on the recommendation. Look, the whole point of this exercise isn't just to think about a problem, it's to arrive at a clear answer. A great recommendation is direct, it's actionable, and it flows perfectly from the analysis you just did. It tells you or your client exactly what to do next. No ambiguity.
All right, that's enough theory. The best way to really, truly get a feel for the ITAR framework is to see it in action. So let's get our hands dirty. I've got an email right here from a client, and we're going to use our new 4-step framework to give her a clear, confident, and correct answer.
Okay, here's the situation. The email is from Carmen. She's traveling for work, her husband Greg is at home, and he's paying for a nanny for their daughter. Her question is basically twofold. 1, can they deduct these costs at all? And 2, who should do it? She's thinking that since she's the higher earner, maybe it would be better for her to claim the deduction. That's a good question. Let's see what the rules have to say.
Okay, let's get to work. We have our problem, we have our framework, we are now going to apply the ITAR method, one step at a time, to solve Carmen's childcare question with absolute precision.
First things first, step 1. Let's identify the issue. If we boil down Carmen's email, we get two very clear questions. Question 1, are the childcare costs for their daughter Lynn even deductible in the first place? And question 2, which is the one she's really focused on, who gets to claim that deduction, Carmen or Greg? Perfect. Our issue is now clearly defined.
Okay, next up, step 2. We need to find the rule. So, we go to the country's official tax rule book, the Income Tax Act, and a quick search leads us directly to Section 63. This section is all about childcare costs. This is our source of truth. Everything we need to answer Carmen's question is right here in this specific section. No need to guess, no need to ask a friend. We've got the law right in front of us.
Now for the big one, step 3, the analysis. Before we can apply the rule, we have to get our facts straight. So what do we know? Carmen told us they paid $12,000 for the nanny. Their daughter, Lynn, is 6 years old and she has no income of her own. And here's the crucial part. Greg's income is $45,000 while Carmen's is $70,000. These are the puzzle pieces we're going to use.
So the very first test in Section 63 is to determine if Lynn is an eligible child. The rule gives us two clear criteria to check. First criterion, is the child under 16? Yep, Lynn is 6. Check. Second criterion, does the child have a lot of income? Nope, Lynn has 0 income. Check. So our analysis leads to a clear conclusion, yes, Lynn is an eligible child. We've cleared the first hurdle.
Now we can tackle Carmen's main question. Since she makes more money, can she claim the deduction? Well, the rule here is honestly about as black and white as it gets. In a two-parent family, the deduction must, and I mean must, be claimed by the lower income spouse. There's no choice in the matter. Since Greg's income is lower, he is the one who has to claim it. So we've just answered her biggest question.
Okay, so we know Greg is the one who has to claim the deduction, but the next obvious question is how much can he claim? Now, they paid $12,000, but that doesn't mean they can deduct $12,000. The Income Tax Act puts a limit on the deduction. The actual amount they can claim is the least of 3 very specific numbers that we have to calculate. So let's break that down. Here is the 3-part calculation. Amount number 1 is simple. It's what they actually paid, which is $12,000. Amount 2 is the annual limit set by the law for any child under the age of 7, and that limit is currently $7,000. And amount 3 is 2/3 of the lower earner's income. So that's 2/3 of Greg's $45,000, which comes out to $30,000. The rule is simple. You have to take the lowest of those 3 numbers.
So when you compare the $12,000 they paid, the $30,000 based on Greg's income, and the hard cap of $7,000, well, the lowest number is pretty obvious. It's $7,000. So even though they spent more, the maximum amount they are legally allowed to deduct is $7,000. Our analysis is now complete.
We've done it. We've done all the hard work. We identified the issue, we found the right rule, and we systematically analyzed all the facts. All that's left now is to package this up into a clear, simple, and actionable recommendation for Carmen. This is our 4th and final step, the recommendation.
So here is our final recommendation for Carmen. Number 1, you can deduct exactly $7,000 of your childcare expenses. Number 2, these expenses absolutely must be claimed on Greg's tax return because he's the lower income spouse. And number 3, and this is what separates a good analysis from a great one, we give our little extra value. We give her a heads up. Next year, when Lynn turns 7, that annual limit drops to $4,000. Now that is a complete and useful answer.
And there you have it. We took a confusing real-world question, we applied a simple 4-step framework, and we arrived at a confident, correct, and clear answer. The ITAR method, issue, tax rule, analysis, and recommendation, isn't just for us tax geeks. It's a mental model, a tool for bringing order and clarity to any complex situation. So I'll leave you with this thought. What's the next complex problem in your life? A big decision, a negotiation, a contract that you're going to solve with your new tool?